what is a hedge? There must be an underlying exposure. And then we looked at what is risk, and we determined that risk is the impact on our objectives. So we talked about how it's useful to consider the context, so the business context for you or your business objectives, for example. Then we went into how to calculate FX risk, and I put in brackets there inherent and residual, and we'll come on to those in a minute. And also, should I hedge? So the 4 questions to ask yourself before entering into any kind of financial instrument, any derivative. Is there an underlying? Is the risk material enough to even bother? Is it practical to do so? And is the cost palatable? Is it prohibitively expensive? Then you might not want to. And then we looked at value at risk, which we said was your new FX risk measurement and your benchmark. That's your maximum potential risk, your maximum loss across a particular time period with a set confidence level. And then we discussed stress testing as well, which works really nicely in tandem with value at risk. And finally, from there, we looked at how to design a strategy. So basically answering the question, how much, how far, and how often. We did some demos for value at risk and stress testing. And I'm pleased that several people from the last session did get in touch for some assistance on those. So if you saw it and you're interested and you want some help, then just get in touch. We'd be very happy to lend a hand with that. So into today's session, first thing before we look at how to how to measure the effectiveness of your strategy is that the idea of inherent and residual risk. So inherent risk, per the lovely graphic on the right-hand side of the page there, is the risk in the absence of control. So it's your currency risk before you do anything about it. And then residual risk is the effect after control. So you've got, per the table, we see a 1-month value at risk of 143k. After the effect of hedges, we've got a value at risk, residual risk of 44k. So that 100k difference is the effect that the risk controls are having. And this is really how we know if a strategy is working or not. And we suggest that you put a threshold for each of your risk metrics. That gives you something to work towards in terms of how much should I be hedging to bring that risk down within a level that's appropriate and within a threshold for the business. So just wanted to get through that first before we move on. And again, with the inherent and residual risk, here's a little chart of a stress test. I think we used this in the last session as well. And we'd really recommend maintaining a regular rhythm for reporting on your risk level. So whether that's monthly or quarterly, from the finance team up to the board. And again, you should definitely have a benchmark for your various risk metrics. In terms of what that reporting should look like, well, probably 3 things really as a minimum. 1, a trade blotter. So what trades have you executed during the period of time? So maybe it's you're preparing a report for July. What trades have you entered and what have you got outstanding? And what's your hedge position? So how many hedges in place? What's your hedge ratio? And then your metrics, so whether you're using stress test, value at risk, or others. And again, I've touched on this slide about the powerful combination of value at risk and stress testing. And that's because of the statistical way that value at risk is calculated. You know, it's not hypothetical. It is a statistical potential loss for a certain confidence level. But don't forget, it's not the maximum possible loss. That's where the stress testing comes in, that sort of severe 20% move. That should give you your worst case scenario. So I've mentioned what other metrics. So what other metrics might you consider? So here's a few ideas that you can take away from today, I hope, and I've highlighted a few. And actually the first 3 should be relatively straightforward. So FX gain or loss, this is your net profit and loss versus the spot rate. Or even a better benchmark is your budget rate, in my view. Then the hedge ratio, so what percentage of your exposure is currently hedged? And I'd suggest that percentage, maybe it's 50% or 60%, that should be tied to something. So if your value at risk threshold is 100,000, for example, then what hedge ratio will bring you down to there? And you should be able to calculate that. If not, we can do it for you. And then margin impact. So what's the FX impact to your gross margin? Volatility is really important. So volatility of your realized exchange rates versus the market. If you're unable to do that, we can help you with that. But again, that's an important one to flag. And then you might consider FX risk contribution. So what's the financial FX risk? What's the component of the FX risk in terms of your overall business risk? What does that percentage look like? And then don't forget margin call risk. So if you're entering forward contracts or options contracts, then of course there's a potential risk to cash flow if those trades move out of the money and you're called for margin, called to pay deposits against those trades. And finally, there's two cousins, if you like, to value at risk: cash flow at risk and earnings at risk. Very similar, but they relate to future cash flows and future earnings as well. But I think for everyone on the call, certainly those first three, FX gain and loss, hedge ratio, and margin impact, you should be able to do yourselves. Don't forget margin call risk. And with the volatility piece, then we'd be very happy to help with that too. So the name of this program is the science behind creating effective hedging policies, isn't it? So we're going to go into how to test now, and we're going to look at back testing. So back testing is a historical performance evaluation. It's a process of evaluating a strategy against real historical trading data. So, for example, how would strategy A, B, or C have worked last year or the year before? I think it's really useful in decision making. So you can look at a previous year and you could say, well, we know how we did act. If we'd have taken this approach, would we have changed our behaviors? Would it have made a difference? But please be careful and please be warned of curve fitting. So what does that mean? It basically means designing a strategy for a year. So 2022, for example, was a really bad year. Well, we should have hedged everything. Okay, well, that might not work going forwards. And there's assumptions and oversimplifications in the modeling as well that can come through. So we all remember what happened. I'm sure everyone on the call remember what happened with the pound last year around October time, when Liz Truss was in power for that brief stint. Well, would you have entered a hedge around that time, or would you have held off? So if you're using a model and the model tells you that you would have hedged then that's an assumption and oversimplification. So again, it doesn't represent the future, but I think it's particularly useful to look at back testing as a decision making, a sort of behavioral, the qualitative stuff. So with that, what I'm going to do is jump into our first screen share. And there's two things we'll be doing a screen share on today. One is back testing and one is not forward testing. We're going to do some random walk analysis. So I'm going to bring up my screen now and go through this. Okay, please give me a nudge in the comments if that needs to be zoomed in. I think it's appropriately zoomed, but here we've got our back testing tool that we use here at Oku, and there we go. You should be able to see there now. What we've loaded up is sterling against the dollar, so GBP USD, and we're a UK importer, so we sell the pound. And we've got a monthly requirement to settle $1 million onto our suppliers, for example. And our first delivery is the end of the month. So we'll use 2022, shall we? Or we could do a different year. Let's do a different year than 2022. 2021. Okay, brilliant. And let's just change the axis a little bit. There we go. Okay, super. So quite a volatile year by the looks of things. So we're just going to put some data into the back tester to get started. So perhaps we set a budget rate of, let's call it 1.35. So we've got our budget rate now shown on the chart. There we are. And we could perhaps do a static hedge. So a static hedge, if you're on the first session, is a hedge. It's like a set and forget approach. You do one trade, usually at the start of the financial year or just before, and that's to cover your full requirement. So let's say we did that on 5th of January 2021, for example. Okay, so there's our static hedge that's just come into play here. So we can see where we would have been hedged for the year. So that's not a very good level, but it's above budget at least. Okay, so if we did a rolling hedge, let's say we wanted to hedge 80% across a quarter, so 13 weeks, and we're going to make a hedging decision every month. So it's fairly relatively infrequent process. and we do our first trade on the same date, the 5th of January, we can now see our rolling hedge coming into play. And of course, there's a 20% top up involved here. So that's why we're seeing some participation in the market. Or we could do a layered hedge. And let's say we want to do let's do a 26 week, so a 6-month hedge with a maximum hedge percentage of 100%. So 100% for the first 2 periods. We're going to do that monthly with 3 steps, 25% a piece. So 100% for the first 2, and then 75, and then 50, and our first trade on the 5th of January, 2021. Okay, so there's our 6-month rolling layered hedge. Now, obviously, I've just made these numbers up for now, but this is the purpose of the back test. So this model, this tool, has now crunched all the numbers. It said when we would do a trade based on the schedule we've inputted, and it's calculated all the relevant P&Ls for that. So in the table here, we can see how each hedging strategy would have performed. And we also get some visual cues, right? So we can see that when the market rallied up into the low 140s, we can see the effect, the lagging effect in the layered program, and indeed on the rolling hedge. So I can potentially adjust this to a 13-week instead. And there we are. So it's a quarterly hedge. So again, the idea of the back tester, as I mentioned, is really to generate the strip of hedges that you would have done according to a certain model, and then calculate the P&Ls and the volatility from components. So you can basically look back and say which program would have been best for us, and you can then say, well, how would it work going forward? Just reaching out to anyone in the comments if you've got any questions on this. Again, it's quite a useful tool. We use it especially at the start of a relationship with a client, where we basically take their trading data for a previous year and we draw a comparison of here's what you might have done, especially for things like rolling or layered hedging programs, which might be quite complex to do internally. But no questions for now. So again, that's our backtesting tool. So I just wanted to show that to you. And we'll just remove the screen. So don't forget, as I said, the limitations of course, curve fitting is the big one for me. So another thing that you can do in terms of testing an approach is something called forward testing. And we're doing this right now for 2 companies. So one's a food manufacturer, another one's in the IT space, and it's kind of like paper trading. So you basically run a hedging strategy on paper or in an Excel spreadsheet, more likely, against the live market, but you never actually execute trades. You record the trades that you would have done. This is really useful because you can inject the real-time what-if reactions. So if the pound were to go up today by a few percentage points, then you're going to be living that in the moment. And you could, if there's a hedging decision to be made, if this week is your hedging window, then would you trade today? Rather than looking back in hindsight. So the back tester really is a hindsight kind of approach, and it can be that can be a limitation. But the forward testing, that paper trading, running a test alongside reality is particularly useful, I think. But just be careful of emotions or lack of. So you're looking at everything in the cold light of day, or are you going to potentially make an emotional decision that you might not otherwise have done with the real life trading? And the next one is random walk analysis. So we've looked backwards. We've looked backwards with the back tester. We're running something concurrently to our actual hedging with the forward testing. Well, what about the future, right? So where might things go into the future? So this is where random walk analysis comes in. And what we aim to do here is to model random price movements. And this is quite useful for looking at a strategy or a number of strategies in A, B, and C to a potential rate path in the future. So where might the market go? And then again, I've put on the slide there, it's the qualitative stuff that I'm interested in. So how would you react if euro dollar went to 130, for example? What would you do? What would the impacts be to your customer pricing in your market? So with that, I've got another demo to bring up. And just like last time when we looked at the value at risk, I prepared a Google Sheet demo for this. We're very happy to share some of this with anyone on the call who's interested if you want to run through this in your own business. So I'll bring up the Google Sheet now, and we can go through it. Now, I think this one's pretty cool, to be honest, but let's see what you think. Feel free to let me know in the comments. So with the random walk analysis, there's a couple of things we need to do. And first thing I'm going to say is, I'm sure you're all aware that in Excel and Google Sheets, there's a random number generator. It's just equals RAND, open close brackets. And that's going to give you a random number between 0 and 1. It's really useful for generating those random numbers, but we are going to use it, but maybe not in the way that you think. So if I scroll to the right over here, you can see what I've got is just a table of euro dollar end of day closing prices from yesterday going back to, where does this go? That goes back to the 1st of January 2022. So what I'm interested in is, instead of just a completely random price for tomorrow, I'm interested in the price movement from one day to the next. So we call those the daily returns. So, and I don't want to just make the daily return random. I'd like to take some of the feel from the real market. So what I'm going to do is I'm going to look at the log returns from the market, and we did this last time in session 1 with the value at risk piece. So very simply, in Excel or in Google Sheets, it's equals ln, and then you're going to take the most recent date divided by the previous date, and you're just going to drag that down to the bottom. And there we get a daily log return. Switching over to this side of the sheet, I'm going to take the mean, so it's just the average, and the standard deviation, SDDev, of the returns. So it's the returns, not the prices. And that's going to give me the daily average return and the daily volatility number, the standard deviation number. This, by the way, equates to an annualized vol of 9.38%. So it sounds about right, doesn't it? So now we've got the mean and the standard deviation. How do we start to prepare the random daily changes? So we'll just scroll down a touch, and you can see this is our chart here. I can refresh that, and it's going to give me nice new random pathways. So starting with today's date, the 27th of July, you can put any number in here. I've used Google's Google Finance function to bring me the current euro dollar spot price, so 110.31-ish. In order to get the next return, I'm going to use the norm inv, the norm inv function. And this is basically going to bring me the number that corresponds to a predetermined probability mean and standard deviation from the normal distribution curve. So how do we do it? Relatively simply, multiply the previous day exchange rate by 1 plus, and then there's our random price change. So in order to do that, we're going to randomize the probability, and then we're going to use the actual log returns mean and the actual log returns standard deviation, and then just drag it down. So there's the formula. Again, I can give this to anybody after the call. It's absolutely fine. And that, once we refresh it, gives us these nice random price changes per day. And it looks like a real market chart, doesn't it? Because it's exhibiting similar levels of volatility on an intraday basis than the actual market has in the past. And I've put here a couple of ideas. Well, what about a volatility input? And what about drift? So here's some ideas for the future if you're doing this. Well, maybe you want to simulate a lower volatility. So I could just overwrite this with 0.4, and I'm going to get a lower vol, or I could put 0.7, I'm going to get a higher vol. So I can put in my own volatility numbers if I want to, and then drift. So what about if we think the market's going to drift one way? So we can compute that as well. So that's all well and good, and you're probably on the call thinking that's very nice, and it's cool that it changes, but what am I going to do with it? Well, first thing, it's not necessarily where the rate gets to. I've put it on the chart here. It's not the destination, but it's the journey that we're really interested in, because it's that random journey through time that we can use to measure the effectiveness of a potential hedging program. And in fact, we can do this. If we can do it once, we can do it lots of times. So here's 25 random walks, and we can have Excel or Google Sheets do this for any number really. I mean, it probably wouldn't like doing more than 100 or so, I wouldn't have thought. But to answer the question, what's the point? Well, let's say we've got some US dollars to buy. So we're a euro dollar business and we have a monthly requirement of $1 million to purchase. And we've got a relatively simple 3-month layered hedging program where we just hedge 100% for the first month over here, 75% for month 2 and 50% for month 3. I can change these if I want to. It's 25, but I'll leave them as they were. So here's our hedging program. You can see that. I'll just zoom in a touch. There we go. There's our hedging program we can see for each of the months. And then we can use this to say, well, is this the right strategy for us? How would we react if? And we can consider the approach to our pricing. So if I scroll down the sheet, we can see on this chart, there's our US dollar forecast in red. And we've got the blue of the spot line. This is what the spot rate's done, according to the chart over here. And then we've got the yellow of our realized exchange rate. So what would we have actually achieved by taking this approach? And we can rerun the numbers. So we can see in this instance, it looks like the market's moving higher. So the layered hedging program is going to exhibit a smoother profile, lower volatility, but it's going to lag the market. So maybe we could ask ourselves, well, if the market went from a low of about, what's this, 1.08 all the way up to 136, how's that going to affect our pricing? What's our competition going to be doing? Are our customers going to be phoning us up, asking us for discounts? So if we had a long-term hedge, then that might very well put us at a competitive disadvantage. So equally, if the market were to go, let's try and get one going down. There we go, a hump in the middle. So we can see we're going to participate with that rise, but relatively a little bit lagged and with some smoothing. And then we're not going to see this very sharp, steep fall until a couple of months later with some smoothing. So this is, for me, the random walk analysis is very useful for how would we react if. It's the qualitative stuff, again, that I mentioned. And you can sit around the table with your decision makers in the business, and you can pull up 2 or 3 of these, and you can say, well, what would we do if? How would the market react if this was the case? So hope you found that useful. This is the sort of science behind it. That's the point of these sessions. I'll just go back to the slides. So that was random walk analysis. I'll just pause for there for a second, just to see if anyone in the chat has any questions, because we've just gone through, appreciate a few things really quite rapidly. We've done back testing with a demo. We've talked about how it can be useful for looking at the qualitative stuff. How would this strategy have worked in the past? But be careful of curve fitting. We've looked at forward testing, so paper trades running concurrently alongside your actual hedging, and then random walk analysis for the future. Where might things go in the future? So once we've done some testing and we've understood how our strategies ABC would work in various market conditions, and we've decided that strategy A or strategy B is the right one for us, it's time to build a policy. So first thing to say is we can help with this, and I've just put on an image there of our policy template that we use with all of our clients, and we'd absolutely recommend that the metrics that you should be using. We could do your risk calculations for you, can help you to formulate a strategy when we do all the testing, all the modeling for you, and we'd even write the document for you as well for board sign off. And then from that policy document comes a set of procedure notes and process guides. So that's just a little offer out to anyone on the call who's thinking that this might be useful for you and you don't have the time or the internal experience to do so. So with the policy, it doesn't have to be a huge document, right? You know, I just put up a screenshot there of what looked like a 12-page template. It can be 2 pages, really, depending on the level of sophistication in the business or what you need it to be. As a minimum, we'd suggest 4 things. So risk quantification. So what is our risk and how do we measure it? Our risk mitigation strategy. And I've put on an image from a slide pack. This is the sort of thing that we do for our clients and the way that we demonstrate it. Risk reporting. So how are you going to report on your risk level on an ongoing basis, your inherent and your residual risk? Who's going to do it? What are the metrics you're going to use? What are the thresholds and benchmarks? And then finally, approvals. So counterparties, banks and brokers, What instruments are you allowed to use? Can you use currency options? Can you use forward contracts? Those sorts of things. And then personnel. Who's executing the trades? What are the authorized limits? So Brian can trade up to 1 million. Sophie can trade up to 2 million, that sort of thing. Again, they're the 4 minimums that we'd suggest to have in any policy. But please remember, again, it doesn't have to be a huge document, but do remember, by having the policy in place, that creates a process which gives a mandate and shares accountability. And these are the 2 or 3 things that are really resonating with financial decision makers in the conversations we're having on a daily basis, is that making decisions, making better decisions, and sharing accountability. So we're pretty much coming to the end of today, so pretty much bang on 30 minutes or so. Let's do a quick recap. So for us, knowing your risk level and your metrics, so are you using value at risk, stress testing, hedge percentage, these sorts of things? Are you using any kind of P&L, net FX P&L versus a budget rate? Having that in place and reporting on it regularly really is essential. You've got your back testing to help make decisions, but be aware of the limitations regarding emotions, curve fitting, that sort of thing. If you're not able to do that and you'd like us to do some back testing for you, let us know. I've just given you a demo to show you how quickly we can do it. And then random walks. So what might the future bring? How would a strategy perform with a completely random forward path for exchange rates? And then policy. So you probably need a policy in your business. It doesn't have to be War and Peace. It can just be a couple of pages. And I've given you the 4 things you must put in there. And again, we can help write that policy for you, design your strategy, and do all the testing and all the reporting as well. So add me on LinkedIn if we're not already connected. You can email me, harry@okumarkets.com, for the guide to risk management PDF. If you need anything, just shout. If you'd like a copy of the random walk Google Sheet, just let me know, send me a DM, send me an email, or just give me a call. I'd be very happy to provide that as well. And yep, I'm going to send a survey at the end as well. So I really appreciate just some feedback. But if there's any questions, we can go through them now. Just put them in the chat. Otherwise, there is my direct dial. A bit risky putting the direct dial on LinkedIn like this, but 0203830250. You can email me, harry@okumarkets.com, and you can connect with me as well. But I hope you found this useful as a way of testing your currency risk strategies with really well-proven ways of working with the back testing and the random walk analysis, and that the forward testing is really valuable as well. So it doesn't look like there's any questions coming through on the chat, so I will leave you to it. Thanks so much for joining, and we'll see you next time. Cheers.